Let's have a look at the more popular and better working candlestick patterns that we very often see in the larger time frames. The first one we're going to look at is called a doji. A doji looks like a cross with the same opening and closing price. What it means is a doji candlestick is essentially unchanged. Hence it represents market indecision. It's like an area of congestion compressed into one candlestick. How we can use to trade it is treat it as a reverse signal if there is a trend to reverse, or we could treat it as a signal to stand aside if there is no clear trend that can be reversed. As the example on the right shows you, we had a doji formed at the end of a downward thrust, and it reversed the channel, sending it back up. We would wait for the doji to be broken, meaning we want the price level to go above the doji before you use it as confirmation that the market is actually changing direction. Next one up is the marubozu. It is the polar opposite of a doji. Its opening price and closing price are at the extreme ends of the candlestick, so visually it looks like a block. A marubozu that closes higher signifies a powerful bullish strength, while one that closes lower shows extreme bearishness. It's more useful as a learning tool than as a pattern for trading. Together with the doji candlestick, they highlight the extremes of the candlestick spectrum. By placing a candlestick on the spectrum, we're able to judge the directional strength of any bar. If you must trade the marubozu pattern, consider the following: continuation of a pattern in a strong breakout aligned with a market bias, or part of another candlestick pattern. The harami is one of my favorite candlestick patterns. It's also known as an inside bar for some of the other price action enthusiasts. Harami means pregnant in Old Japanese. The first candlestick is the mother, and the second candlestick is the baby. Focus on their bodies. The body of the baby bar must be entirely within the body of the mother bar. Typically, in a bullish harami, the first bar closes lower than it opens, while the second bar closes higher. In a bearish harami, the first bar closes higher, while the second bar closes lower. It means that the market has come to a muted reversal. The candle body stands for the real price change of the candle regardless of its intra-candle excursions. Hence, it represents the real and conclusive movement of the candlestick. The smaller candle body points to decreased volatility. So how do we trade it? In a bull trend, we use the bullish harami to pinpoint the end of a bearish retracement. In a bear trend, we use the bearish harami to pinpoint the end of a bullish retracement. Engulfing candlesticks is simply the opposite of a harami pattern horizontally, and if you take a harami and flip it, you'll see the engulfing pattern. The body of the second candle completely engulfs the body of the first. Again, the focus on the candle bodies looks for a real reversal. In this case, the second candle body fully engulfs the first and represents a strong reversal signal. How we trade it is in a bull trend, you buy above the bullish engulfing pattern for a bullish continuation. In a bear trend, you would sell below the bearish engulfing pattern for a bearish continuation. Here we have the piercing line, sometimes known as the dark cloud cover. The piercing line and the dark cloud cover refer to the bullish and bearish variants of the same two-bar pattern. The first candlestick of the piercing line pattern is bearish. The second candlestick opens below the low of the first candlestick and closes above the midpoint of the first candlestick. As for dark cloud cover pattern, the first candlestick is bullish. The second candlestick opens above the high of the first candlestick and closes below the midpoint of the first candlestick. Due to the first criteria of both patterns, the second bar must open with a gap away from the close of the first bar. Hence, these candlestick patterns are unusual in intraday time frames where gaps are uncommon. So what does it mean? It means some traders are sorely disappointed. In the piercing line pattern, the second bar opened with a gap down, giving an initial hope of a strong bearish follow-through. However, not only did the bearishness fail to materialize, it proceeded to erase more than half of the bearish gains from the first bar. This bullish shock offers a great long trade. Likewise, in the dark cloud cover pattern, the first gap up prompted hope from the bulls before the lower close crushed it. So how do we trade it? Find major bullish reversals with the piercing line pattern, preferably after a break of a bear trend line. Or find major bearish reversals with dark cloud cover pattern, preferably after a break of a bear trend line. The hammer or hanging man candlesticks. let's get this straight. Both the hammer and the hanging man patterns look exactly the same. Both have a candle body near the top of the candlestick and a long lower shadow, around twice the size of the candle body at least. The difference is this: the hammer pattern is found after a market decline and is a bullish signal. However, the hanging man appears as an ill omen at the end of a bull run and is a bearish signal. The hammer pattern traps traders who sold in the lower region of the candlestick, forcing them to cover their shorts. As a result, they produce buying pressure for this bullish pattern. Its bar pattern equivalent is the bullish pin bar. The hanging man pattern is seemingly bullish candlestick at the top of an upwards trend. Infected by its optimism, traders buy into the market confidently. Hence, when the market falls later, it jerks these buys out of their long positions. This also explains why it is better to wait for a bearish confirmation before going short based on the hanging man pattern. So how we trade it is, in a downtrend, you would buy above the hammer pattern for a reversal play. You can also trade the hammer pattern like a bullish pin bar. In an uptrend, sell below the hanging man pattern for a reversal play after bearish confirmation. The inverted hammer or shooting star candlesticks. All you do is you take the hammer pattern and invert it. It's exactly the same shape, just upside down. The inverted hammer is visually identical to the shooting star pattern. The difference is where you find them. An inverted hammer is found at the end of a downtrend, while a shooting star is found at the end of an uptrend. What this means is the inverted hammer is a bullish pattern. In a downtrend, the inverted hammer pattern emboldens the sellers. Hence, when the inverted hammer fails to push the market down, the bullish reaction is violent. The bearish shooting star pattern implies a different logic. The shooting star traps buyers who bought in at its higher price range, forcing them to sell off their long positions and hence creating selling pressure. Its bar pattern equivalent is the bearish pin bar. So how do we trade it? In a downtrend, you buy above the inverted hammer pattern for a reversal play after a bullish confirmation. In an uptrend, you sell below the shooting star pattern for a reversal play. The morning star or evening star. Both star patterns are 3-bar patterns. In candle speak, a star refers to a candlestick with a small body that does not overlap with the preceding candle body. Since the candle bodies do not overlap, forming a star will always involve a gap. Thus, it is uncommon to find morning stars and evening stars in intraday charts. A morning star comprises of the following: a long bearish candlestick, a star below it, either bullish or bearish, a bullish candlestick that closes within the body of the first candlestick. An evening star comprises of a long bullish candle, a star above it, either bullish or bearish, and a bearish candlestick that closes within the body of the first candlestick. This pattern is similar to the 3-bar reversal. So what does it mean? The first candlestick in the morning star pattern shows the bears in control. The star hints at a transition to a bullish market. Finally, the strength of the last candlestick confirms the bullishness. The evening star expresses the same logic. The first candlestick shows the bulls in control, uncertainty sets in with the star candle, and the last candlestick confirms the bearishness. So how do we trade it? We apply both patterns to catch reversals as well as continuations. You buy above the last bar of the morning star formation, or sell below the last bar of the evening star formation. 3 white soldiers or 3 black crows. What does it look like? Each of the 3 candlesticks in the 3 white soldiers should open within the previous candle body and close near its high. Each of the 3 candlesticks in the 3 black crows should open within the previous candle body and close near its low. In the 3 white soldiers pattern, each bar opens within the body of the previous candlestick and suggests a potential fall. However, each bar ends up with a strong and high close. After 3 instances, the bullish is undeniable. In the 3 black crows pattern, each bar opens up within the body of the previous candlestick, suggesting bullishness. However, as each bar closes lower, the bearishness is clear. So how do we trade it? These patterns are effective for trading reversals. You buy above the 3 white soldiers after a substantial market decline, or sell below the 3 black crows after a substantial market rise. The final one we're going to look at is called the hikaki. Despite having a Japanese-sounding name, the Hikaki is not one of the classic candlestick patterns. However, it is an interesting pattern that illustrates the concept of trapped traders. To find a Hikaki pattern, first look for an inside bar. For a bullish Hikaki, the candlestick after the inside bar must have a lower low and a lower high to signify a bearish breakout of the inside bar. When this bearish breakout fails, we get a long Hikaki setup. For a bearish Hikaki, the next candlestick must have a higher high and higher low. When this bullish breakout in the inside bar fails, the market forms a short Hikaki setup. So what does it mean? The Hikaki pattern pinpoints the failure of inside bar traders. Trading the breakouts of inside bars is a popular strategy. When the breakout fails, we expect the price to blaze in the other direction. And how do we trade it? Well, we use Hikaki for continuation trades. Buy if a downside breakout of an inside bar fails within 3 bars, or sell if an upside breakout of an inside bar fails within 3 bars.